Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the economy in China because we've now got some of the data for June, and that data tells us that things are still really bad in China. And in fact, they're starting to get worse. And one of the first pieces of data I want to talk about is what's going on with factory gate prices. And factory gate prices are absolutely critical to China because it's a manufacturing nation. That's basically at the heart of the Chinese economy. China makes things and then sells them all around the world. And in order for their companies to grow, they need to see factory gate prices going up. But unfortunately, the data for June shows that factory gate prices have fallen for a consecutive 33 months. And the fall in June was actually the worst that's been seen in China for 2 years. If we have a look at the data for the last 12 months, you can see that 12 months ago in June 24, factory gate prices fell by 0.8%. However, as you can see, over the last 12 months, the situation has got significantly worse. If you look at the scale on the right-hand side of this chart, it actually starts at 0% at the top. So that's basically no growth in factory gate prices and goes down to 3.8 minus at the bottom. And as you can see, in June 2025, factory gate prices fell by 3.6%. So that means that basically companies in China are selling their products today for 3.6% lower than they were this time last year. Now, obviously, as a consumer, that sounds like a great deal. Everybody wants prices to go down, so you've got more money to spend, more money to save, more money to do things. But if you're a company, if you put yourselves in the shoes of the owners of these businesses, you've got rising costs. You're having to pay more for people because wages continually go up in China. You're having to pay more for fuel and energy costs and rent costs and raw material costs because we're seeing raw material prices rising all across the world. So when all of your costs are going up, but your sales price is going down, what that means is that you're making less profit than you were this time last year. And as I've talked about in many videos before, it's estimated that over 50% of the companies in China are now making losses because basically they've been giving away margin for the past 12 months. You can see here that the margins have been eroded. And if we expand the scale of this chart to show what's been happening over the past 3 years, you can see that this has been in negative territory for a very long time. We look at the scale on the right-hand side here. It goes from plus 7% at the top to minus 7% at the bottom. And this line actually moved into negative territory in October 2022. That was almost 3 years ago. 33 months of consecutive price falls for companies is extremely bad news. That is why the Chinese economy, or one of the reasons why the Chinese economy is in such a dire situation at the moment. And if we look at the Purchasing Managers Index, which is basically an index of it's a survey that's taken every single month, and all of the big companies are surveyed, and their purchasing managers fill in all of the details about what they're doing in their business, whether they're making more orders for raw materials, whether they're receiving more sales orders. So it basically tells us whether companies are growing or expanding. And the key number in the Purchasing Managers Index is 50. A score of 50 means that nothing is happening. You're neither growing nor contracting. If you've got a score above 50, then that means your company is expanding. If it's below 50, then it's getting smaller. Basically, you're making less sales, less revenue. And if we look at the figures for June 25, it's come in at 49.7. So that's obviously below 50, which means that companies in China are contracting. And if we look at what's been happening over the last 12 months, you can see that in April, May, and June, the score has been below 50 in every single month. It was also below in January 25 and August and July 24. So what we've got here is a picture whereby companies are contracting at the same time as factory gate prices are falling. So they're being hit from both sides. They're seeing a reduction in the amount of sales that they're making, and they're also seeing a cut in their margins. And that's bad news for any business. And this has been going on for a long period of time. And if we expand the scale of this chart so that we're looking back to July 2022, you can see that basically the red line here, which is the manufacturing PMI, the Purchasing Managers Index, has been pretty much below 50 the whole time. There's been a couple of periods where it's jumped up, and that's predominantly because the Chinese authorities have been boosting the economy. They've been taking measures to try to give the economy a shot in the arm. But unfortunately, as you can see, those shots in the arm have not had a long lasting effect. They have a short term bounce where we see a rise above 50 and then it dropped back down again. And this is a major problem from China's point of view, because if it can't get its manufacturing companies going, if it can't get them back to actually growing and hitting profitability, then China is going to be in a very difficult situation, because that is the heartbeat of the Chinese economy. Now, one of the other problems that China has been encountering has been the lack of demand within China. China has a population of 1.4 billion, and I know a lot of people will be sending me messages immediately saying they do not. They have the population 600,000 or 700,000. Well, the official figure is 1.4 billion. So that's what I'm sticking with. It might be, if you've done a personal count, you've been over there and counted everybody, then maybe you know better than I do. But let's just take it as read that it's 1.4 billion. So it's a big population. So that should equate to a large amount of demand, and therefore Chinese companies should be able to make lots of profit and grow just from the domestic market. But the problem that China has is that inflation has actually been in negative territory for the past few months. This chart shows the official rate of inflation over the past year, and you can see that in February of this year, prices actually fell by 0.7%. So the price on the shelves, the price of goods, was lower this year than it was the previous year. And that's obviously great for consumers, but really bad news for companies. And it remained in negative territory in March, April, and May. Now, in June, there has been a reversal of that. We've seen an increase in prices of 0.1%. And 0.1% is pretty minimal. So it doesn't really mean that China is out of the woods. In fact, 0.1% is virtually zero. And if we change the scale of this chart to look at what's been going on month, so this looks at prices this month compared to last month, so it's not an annual range, we're looking at a monthly movement, you can see that in June, prices actually fell by 0.1%. So despite the fact that the year-on-year figure is plus 0.1%, the monthly figure was minus 0.1%. So that tells us that things are not improving rapidly, that prices are still in the doldrums in China. And this is a major problem, because it means that those Chinese companies have to rely on the export market for growth. And as we know, Donald Trump has imposed some significant tariffs against Chinese imports. They're come in at 30% since he's taken over. We did have the brief period where it went up to 145%, but that was soon wiped when we went through the pause period, and a deal has now been signed with China. We don't know the full details of that, but it looks like it's 30% tariff. So at face value, compared to 145%, you might be thinking, well, that sounds like quite a good deal for China. But when you take a step back and think about the bigger picture, before Donald Trump took over as the president, China wasn't paying any tariff, so all of the exports into the USA were being sold with no additional tariff. Now they have an additional tariff of 30%. So that means that something that was costing $100 last year is now costing $130. That is a material increase in the cost of those goods. And what we're seeing is that Chinese companies are seeing lower orders. They're not selling as much in the USA. So they're now losing market share over in the States, which is their biggest export market. So that's a major problem when your home market isn't really growing at all and your export market is shrinking because you've been hit with these tariffs. You're being hit from both sides. And that's what's happening to Chinese businesses at the moment. And if we have a look at this chart, it looks at what's been going on with inflation and the producer price index dating back to 2017. And if we focus in on what's been happening since 2023, you can see the problems that have been occurring in the Chinese economy, because what we've got here is a scale which goes from 15% positive growth on the left, on the top of the chart, to minus 5% growth at the bottom. And you can see that halfway through 2022, we saw producer prices collapse in China. So at the end of 2021, producer prices were actually increasing by 13%. Now, that was an exceptional period because we'd come out of the COVID-19 pandemic. There was a shortage of everything because lots of factories had closed down, and so they'd used up all their stocks. No company had excess stock to sell, and we saw a boom in demand as everybody came out of lockdown and wanted to go and buy things and spend money. So there was a shortage, and there's basically a excess demand over supply. And as you'll know, when we're talking about basic economics, if demand goes up and supply doesn't move, then that means that prices go up. So we saw a heyday for Chinese producers, and they got this massive increase in their producer prices. However, that soon reversed itself. And midway through 2022, we saw producer prices starting to come right down. And as we saw earlier, in October 22, they fell into negative territory, and they've been in negative territory ever since. And if we look at inflation in China, it's followed a similar path. So in 2022, it was up at around 2.5%, which is exactly where the Chinese authorities wanted it to be. However, since that time, it's come down and is now bumbling at these low levels of either 0 or minus 1 or 2%. So this is a major problem for China, because what this tells us is that it's not being able to pass on any cost increases. Companies in China are having to absorb those cost increases, and that means that they're making less profit, and now a lot of them are making losses. And when you take a step back and look at the trend here, it looks difficult for China to turn this around. We're not seeing any marked improvement month on month. It isn't starting to turn the corner. And when you think about what's happening with Donald Trump's tariffs and the impact of that on the Chinese businesses, it's likely to get worse. And one of the other metrics that I wanted to just quickly talk about is what's going on with profits. I've mentioned a couple of times that more than 50% of Chinese companies are now making losses. And we saw the figures in May show that industrial profits actually fell by 9.1%. That is a huge fall year on year in the profits that Chinese companies are making. And a lot of these businesses are state-owned. So basically what that means is that the Chinese state will have to pick up the bill for any losses that those companies make. So what's the summary and conclusion today? Well, I wanted to post this video because we've been following what's going on in China over the past few years, and what we are seeing now are real problems starting to emerge in the Chinese economy, because as we've discussed today, China is dependent on its manufacturing base. That's what it does. It has a low labor cost, and therefore the world has outsourced manufacturing to China. Everybody's happy to buy Chinese-made goods because they're coming in at a significantly lower price than they can be made in other countries. But what China is currently experiencing is its biggest export market is now shrinking as a result of the 30% tariff that's been applied against Chinese imports into the USA. So that's a major problem. It's losing ground with its biggest single customer. And ordinarily, you would think that China would just turn to its home market and therefore sell more goods to its own people. But what we have seen is, for a long period of time, China has been struggling with deflation. So prices just simply haven't been going up. And that's a major problem if you're a business, because on average, your prices will be rising by maybe 2 or 3 or even 5% per year, depending on what's happening with raw materials and energy costs and all of the other costs associated with making things. So Chinese companies have got, on the one hand, an increase in their outgoings, but their income is going down as a result of the fact that they're constantly having to cut their prices. And on top of that, they are losing sales into the USA. So this represents a major problem from China's point of view. And obviously, the one thing we haven't even touched on in today's video is what's going on in the property market, because the property sector in the first 20 years of this century was really boosting the whole economy because it was a license to print money. Lots of different businesses were running around building thousands, tens of thousands, millions of apartments in the first 20 years because there was this huge boom in demand, and the Chinese authorities changed the regulations and allowed people to buy property, and it was seen as being the best investment that you could ever think of. But unfortunately, all of that changed when China changed the rules and prevented those companies from taking on more and more and more debt. A lot of those companies found that they didn't have enough money to pay the debt that they'd taken on, and so they became illiquid. And we've seen companies like Evergrande being liquidated and taken out of the equation. So the property sector is no longer boosting the Chinese economy. So what that means is that China needs its manufacturing base to really start pulling its weight, to build and growth so that China can hit the 5% growth target that it set for 2025. But there is now a major question mark over whether or not China can achieve that 5% because manufacturing simply isn't delivering as a result of the fact that its biggest market has been taken out by the tariffs, and also the fact that there is simply no growth in the Chinese economy. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and thank you so much to everyone that supported me. If you bought me a coffee or sent me a YouTube super thanks, I really appreciate that. And if you've signed up as either a Patreon or a YouTube member or a Buy Me Coffee member, thank you for that support. Really helps to keep me going, and here's something to put a smile on your face.